What's up, traders? Welcome back to Investeen. We are now halfway through this entire CANSLIM series, landing on the fourth letter, which stands for supply and demand. Let's get into the video. So to start off this episode, I'm going to start by explaining the applications of supply and demand in stock market investments, and then move to providing examples of these concepts in stocks today. In a super broad overview, we should primarily be looking for stocks with little supply and soaring demand. When I'm referring to supply, you may be asking, supply of what? Well, I'm referring to the number of shares outstanding. These are the potential amount of stock that are available for purchase. Companies with a smaller amount of shares outstanding will take a smaller amount of demand or lesser volume of purchasing to move the price of the stock upwards. Now, on the other hand, way more buying power will be needed to move the price of a stock with a larger number of shares outstanding. Think of it like this. A small boulder can be moved so easily by just one person. But with the boulder 10 times the size, 10 times the number of people will be needed to move the boulder the same distance. The market capitalization, or the price of a stock multiplied by the total number of shares outstanding, represents the value of a company, typically used as a metric of measuring a company's size. William O'Neill says that a stock with any size market cap can be purchased as long as the other criteria of CANSLIM are met. Companies with smaller market caps and larger market caps have their own distinct advantages. Stocks with smaller market caps typically have a smaller number of shares outstanding, making it easier to move their stock price upward. In addition, their growth potential is large as they have not matured yet, meaning that they will not be getting sluggish with growth anytime soon. However, companies with larger market caps are of better quality and also have greater liquidity as they have typically more trading volume. In addition, because it takes so much buying pressure to move the price up, the same applies for selling pressure to bring the price down for large market cap stocks. There's less downside volatility and less risk involved in these investments. The market does tend to shift its preference of small cap and large cap stocks every now and then. But William O'Neill does say that if all other things are equal, the company with a smaller market cap will tend to outperform. To transition into what criteria is being sought out for by investors, let's talk about another metric, which is floating shares. This subtracts the shares held by controlling investors and company insiders from the outstanding shares. Now, what I'm trying to get at here is that a large variation or gap between the floating shares and outstanding shares means that management is holding a solid percentage of stock. Why is this important? It is so incredibly vital to look for the management themselves owning shares of their company because it shows that they have interest and see growth potential for the company. Management having a low amount of shares means that they don't see much innovation occurring in the future of the company that could lead to the explosive growth that we're looking for. And this transitions really well with our next idea. Not only do we want to see the management's interest in its own stock, but we also want to see a company buying back its own shares on the open market. Buying back shares tells us that a company may be expecting improved sales and earnings coming soon, which are the most important metrics as explained in previous videos. In addition, the net income of a company will be divided by a smaller number of shares for earnings per share calculations, hiking up the EPS as well. This is so important. Stock buybacks and management ownership show that the insiders are confidently putting their money on the fact that their company's performance will be moving upward strongly. Now, to measure the supply and demand of a company, using the daily trading volume indicator shows us the buying or selling pressure of a day. And as I've mentioned in previous videos, volume is the only indicator that I use along some key moving averages. Call me a minimalist, but simple charts are always better than cluttered charts. On upward price moves, we want to see huge volume indicating that institutions are pouring in to purchase shares. This huge volume will be noticeable, and on basing breakouts, volume should be at least 40% to 50% above normal. However, larger volume surges such as 100% and more are also seen, which is an indication of further upward moves. When we say above normal, look to see if the volume bar is well above the average daily volume line that you can switch on in indicator settings. So analyze breakouts and look for above average volume for consolidation breakouts and earnings gap ups. That's not all though. On price pullbacks and corrections, we want to see the downward trading pressure dry up or decrease, indicating that institutions are not dropping their positions. In addition, in basing and consolidation periods, horizontal price movement within a tight range on low volume can be a sign of institutional accumulation and near breakout. IBD's market surge also offers an accumulation and distribution rating to track the institutional purchasing of a stock over the last 13 weeks. The scale is from A+ to E-, where A+ is heavy buying and E- is heavy selling. All in all, volume dry ups for selling pressure is another great sign to look at. Quickly, I just want to move to apply these concepts into some stocks before we end this off. And so the first stock that I want to look into is Tesla. We can see a nice consolidation period over here that had been going on throughout the last couple weeks, operating within a relatively tight price range. We can also see that there was high selling pressure over here, but the volume did begin to dry up right towards here, which is a signal of potential breakout. And we can see that the volume absolutely exploded right here, surging to levels far above the average volume during this basing period. And we can tell that the high volume and price move-up combination was formed through institutional purchasing, which was shown through here in this accumulation and distribution rating being an A+. And this is a great example of supply and demand volume concepts that I just discussed. So the next stock that I want to analyze is SoundHound AI. We can see that there was some selling pressure during this mid to late June time period, but the volume did begin to significantly dry up towards this consolidation basing period where these new lows weren't really being reached. And next thing you know, the stock's volume and price absolutely explode upwards in price, and the volume was more than 15 times the volume during the dried up basing period. And so this really suggests that institutions were pouring in due to how above average this volume really was. And volume spikes like these are what we look for. This is also backed up by the accumulation and distribution rating being an A, suggesting heavy buying pressure. The last stock that I want to analyze is Cirrus Logic. This has been on my watch list recently, and so during this February to May time period, we can see that there was a nice horizontal and wide base being formed, also on relatively low volume. And keep in mind that the volume was only 200 to 300,000 shares traded. Now, when earnings were released, institutions caught their eye and bought a significant number of shares. The volume was almost 8 times more than it had been during this basing period, hitting 1.6 million shares traded. Now, the stock is continuing to hit higher highs on high volume. I'm pretty excited to see where this stock goes in the coming weeks. Thank you so much for watching this video. In the next video, we're going to be covering the 5th letter of CANSLIM, which stands for leader or laggard. See you in the next one.